In this example, we are looking at the preparation of the statement of stockholders' equity. We are going to look at transactions A through F that you see in front of you one by one and show you how they affect the statement of stockholders' equity. Part A says that we issued 10,000 shares of $100 par value 9% cumulative preferred stock at par. So we want to think about the transaction that is involved when we issue the preferred stock. When we issue the preferred stock, we will receive cash and therefore debit cash for the 10,000 shares times the $100 par value, and we would in turn credit our preferred stock. Now, since we are building the statement of stockholders' equity, we are only concerned with the accounts that would be found in the stockholders' equity section of the balance sheet, which would be preferred stock, common stock, additional paid-in capital, retained earnings, and treasury stock. So you can see below where we increased our preferred stock account for $1 million, which gave us a total increase for transaction A of $1 million. For transaction B, we issued 40,000 shares of common stock in connection with the conversion of a bond. So when we talk about bond conversions, what we're doing is we're taking bonds and trading them in for common stock. So when we have bonds, it includes a credit to a bonds payable liability account of $600,000. So if we're trading in the bonds, those bonds will no longer exist, so we will then debit bonds payable for the carrying value of $600,000. Now if we were just simply issuing 40,000 shares of common stock, we would credit our common stock for the 40,000 shares times the $2 par value, and then anything additional would go to our additional paid-in capital. So you can see on the statement of stockholders' equity where this transaction will increase common stock by 80,000, which is the $2 par value times the 40,000 shares that were issued, the 520,000, which is the difference between the carrying value of the bonds and the legal amount that goes to common stock. So additional paid-in capital is increased by 520,000. For transaction C, we declared and issued a 2% common stock dividend. The market value on the date of declaration was $14 per share. So we first must determine how many shares of common stock we have outstanding in order to determine what our 2% will be based on. So you can see that we have $800,000 in common stock to begin with, and then in Part B we issued another $80,000. So those are in dollar amounts, but if we take that $880,000 divided by 2, we come back to how many shares we have outstanding. So we have 440,000 shares outstanding. And a 2% stock dividend means we're going to issue an additional 2% above the 440,000, which would be 8,800 shares. So in our common stock dividend issue, we're going to issue an additional 8,800 shares. So when we think about how what happens in that transaction, it's like issuing common stock. So we're going to issue 88 shares times our $2 par value, which is 17,600. But when we talk about issuing shares of stock that are stock dividends, dividends always decrease our retained earnings for the market value. So if we take the $14 times those 8,800 shares, that's going to be a decrease to our retained earnings. We're basically taking the money out of retained earnings and putting it into common stock because there's no transfer of cash at this point. And then the additional paid-in capital will be the $105,600, which is the difference between the $2 par value and the $14 market value. Part D, we purchased 10,000 shares of common stock for the Treasury at a cost of $16 per share. So we did Treasury stock transactions, and what's happening when we purchase Treasury stock is we're increasing our Treasury stock account and we're decreasing cash. But when it comes to the statement of stockholders' equity, we're only concerned with the Treasury portion. So if we take our 10,000 shares times our cost of $16, it would be a decrease of $160,000 because the Treasury, when we buy Treasury stock, it's always a decrease on our statement of stockholders' equity and also in the balance sheet. For Part E, we earned net income of $460,000. So if you've read about retained earnings, you know that retained earnings is all the money a company has made. So net income would increase retained earnings, where we have learned that cash dividends and stock dividends and losses would decrease retained earnings. But if you think about what happens during the closing process, instead of owner's capital, we would take our income summary and close it into the retained earnings, put it into and increase our retained earnings by that amount. So when we look at the statement of stockholders' equity, the net income would increase our retained earnings by $460,000. In Part F, we declared and paid the full year's dividends on preferred stock and dividends of 46 per share on common stock outstanding. So now we're looking at cash dividends. So first we have to do a few calculations. We're going to look at how many shares of outstanding common stock do we have. And you can see here in blue where we had the $800,000, which divided by 2 was your $400,000, then your $40,000, then your 8,800 shares that we issued in C, plus we have to subtract out the treasury shares because remember treasury shares are no longer outstanding. So we will be paying cash dividend on 438,800 shares, which if you take the 438,000 times 40 cents, you get the 175,520 under the red circle. And then we also have to calculate our preferred dividends. And remember, our preferred dividends are our number of shares outstanding, which is 10,000 shares, times our par value, times our percentage. And that comes up to be $90,000. And you'll notice in this transaction that those are subtracted out of retained earnings because retained earnings is decreased by dividends, cash dividends and stock dividends, and it's increased by our net income. So here's the completion of the statement of stockholders' equity and how transactions A through F affected the statement of stockholders' equity. And you can see that based on all of our changes, we come up with a new balance of our stockholders' equity of $7,834,480, which is an increase from where we started at $6.2 million.